Look, I need to be straight with you about something that's happening right now in the precious metals market. And when I say right now, I mean this is unfolding as we speak. The window to position yourself in physical gold and silver is narrowing faster than most people realize, and if you're not paying attention, you're going to miss what could be the most significant wealth transfer opportunity of this decade. Let me paint you a picture of what's actually happening behind the scenes. While mainstream financial media is busy talking about stock market rallies and cryptocurrency volatility, there's a quiet panic happening in the physical precious metals market that almost nobody is discussing. And I'm not talking about some conspiracy theory or fear-mongering. I'm talking about cold, hard data that tells a story most investors aren't seeing. Here's what I mean. Right now, the COMEX, that's the commodity exchange where precious metals futures are traded, is experiencing something that hasn't happened at this scale in decades. The ratio of paper claims to physical metal has reached levels that would make your head spin. We're talking about potentially hundreds of paper claims for every single ounce of actual, deliverable silver sitting in those vaults. Think about that for a second. Hundreds of people holding contracts that say they own an ounce of silver, but there's only one physical ounce available to deliver. Now, you might be thinking, well, that's how futures markets work. Most people just settle in cash. And you'd be right. Historically, only a tiny fraction of futures contracts actually demand physical delivery. But here's where things get interesting. That's changing, and it's changing fast. Central banks around the world have been on an absolute buying spree when it comes to gold. We're not talking about modest accumulation here. We're talking about record-breaking purchases quarter after quarter. The World Gold Council data shows central banks have been net buyers for years now, but the pace has accelerated dramatically. Why? Because these institutions, the very entities that manage national reserves and understand monetary policy at the deepest levels, are quietly moving away from dollar-denominated assets and into hard assets. Let me give you a specific example. The People's Bank of China has been consistently adding to its gold reserves month after month. But here's the thing that most analysts miss. The official numbers they report are almost certainly understated. China has a long history of accumulating gold quietly and then announcing much larger holdings later. They're not alone. Russia, before recent geopolitical events, was one of the most aggressive buyers. India's central bank has been steadily increasing reserves. Even countries you wouldn't expect, smaller nations that are looking at the global monetary system and making calculated decisions about where to store their wealth. But it's not just central banks. Something fascinating is happening with individual investors too. The premiums on physical gold and silver, that's the amount you pay above the spot price to actually get your hands on a coin or bar, have been stubbornly high. In a normal market, when demand is balanced with supply, these premiums are relatively modest. But right now, dealers are struggling to keep inventory. Mints are running at capacity. The United States Mint, the Royal Canadian Mint, the Perth Mint in Australia, they're all dealing with unprecedented demand. I was talking to a dealer recently who told me something that really stuck with me. He said, I can sell paper silver all day long, but when someone wants to take physical delivery of a significant amount, I'm making phone calls to 5 different suppliers trying to piece together the order. That's not how a healthy, liquid market is supposed to function. Now let's talk about what's driving this, because understanding the why is crucial to understanding where this is headed. We're living through a period of monetary experimentation that has no historical precedent. Think about what's happened over the past few years. Governments around the world have printed money at a pace that would have been unthinkable a generation ago. The Federal Reserve's balance sheet exploded. The European Central Bank, the Bank of Japan, the Bank of England, they've all engaged in massive quantitative easing programs. And here's the thing about printing money. It doesn't create wealth. It dilutes the value of every dollar, every euro, every yen that already exists. It's basic mathematics. If you increase the supply of something without increasing the underlying value it represents, each unit becomes worth less. That's not opinion. That's monetary reality. So what do you do if you're a sophisticated investor or a central bank that understands this? You move into assets that can't be printed. You move into assets that have maintained value for thousands of years. Gold has been money for 5,000 years. Silver has been money for just as long. They've survived the collapse of empires, the fall of currencies, wars, depressions, and every financial crisis in human history. But here's where the currency exit comes in. And this is the part that should really get your attention. There's a growing movement among nations to reduce their dependence on the US dollar as the global reserve currency. This isn't some fringe idea anymore. This is mainstream policy discussion among major economies. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been openly discussing alternatives to dollar-based trade. They've been working on payment systems that bypass the dollar entirely. They've been talking about a potential gold-backed currency or unit of account. Now, whether that specific initiative succeeds or not is almost beside the point. What matters is the direction of travel. What matters is that major economies representing billions of people are actively working to create alternatives to the dollar system. And every time they take a step in that direction, every time another country signs a bilateral trade agreement that settles in local currencies instead of dollars, every time another central bank diversifies away from treasury bonds and into gold, the exit narrows, because there's only so much physical gold and silver available at current prices. Let me give you some numbers to put this in perspective. The entire global gold market, all the gold that's ever been mined in human history, is estimated at around 190,000 metric tons. Sounds like a lot, right? But when you break it down, it's not. About half of that is in jewelry. A significant chunk is in central bank reserves. What's actually available for investment? What's sitting in vaults that could be bought by investors or institutions? It's a surprisingly small amount. And silver? Silver is even more interesting because it's not just a monetary metal. It's an industrial metal. It goes into solar panels, electronics, medical applications, batteries for electric vehicles. It gets consumed. Unlike gold, which mostly just sits in vaults, silver gets used up. The above-ground stockpiles of silver have been declining for years. We're mining it, we're using it, and we're not replacing those stockpiles. So you've got increasing monetary demand from investors who see the writing on the wall with fiat currencies. You've got increasing industrial demand from the green energy transition and technological advancement. And you've got a supply situation that's already tight. That's not a recipe for stable prices. That's a recipe for a squeeze. Now, I want to take a quick moment here because this is important. If you're sitting on retirement savings, maybe you've got $100,000 or more in a traditional IRA or 401k, you need to understand that there are ways to get physical precious metals into those accounts without triggering tax penalties. I put together a comprehensive guide on how gold IRAs actually work, and it's available in the description below. It covers the mechanics, the rules, the custodians, everything you need to know. If that's relevant to your situation, it's worth checking out. But let me get back to what's happening in the market right now. Here's what keeps me up at night. And I mean this genuinely. We're in a situation where the paper market and the physical market are increasingly disconnected. You can look at the spot price of silver on your screen and see it trading at, let's say, $25 an ounce. But if you actually want to buy a significant amount of physical silver, you're paying $28, $29, maybe $30 an ounce depending on the form and the dealer. That spread tells you something. It tells you that the paper price doesn't reflect the reality of physical supply and demand. And what happens when that disconnect becomes too obvious to ignore? What happens when enough people start demanding physical delivery? What happens when the COMEX or the LBMA, that's the London Bullion Market Association, can't meet delivery obligations? History gives us some clues. Go back to the 1970s. After Nixon closed the gold window and ended the direct convertibility of dollars to gold, we saw a massive repricing of precious metals. Gold went from $35 an ounce to over $800 in less than a decade. Silver went from $1.50 to $50. Those weren't just bull markets. Those were monetary resets. Those were the market saying, the old price doesn't reflect the new reality. Or look at what happened in 2008 during the financial crisis. There was a brief moment where you literally couldn't buy physical gold and silver at any price close to the spot price. Dealers were sold out. Premiums went through the roof. People who had been accumulating physical metal before the crisis were sitting pretty. People who waited until the crisis hit found themselves unable to get their hands on metal at reasonable prices. We're seeing early signs of that same dynamic right now. And the scary part is, most people aren't paying attention. They're looking at their stock portfolios. They're watching the Fed's interest rate decisions. They're worried about inflation at the grocery store. All valid concerns. But they're missing the bigger picture. The bigger picture is that we're living through a transition in the global monetary system. The dollar has been the world's reserve currency since the end of World War II. That's given the United States enormous advantages. the ability to run massive deficits, the ability to print money without immediate consequences, the ability to sanction other countries by cutting them off from the dollar system. But that privilege isn't guaranteed forever. And there are signs that it's eroding. When Saudi Arabia starts accepting yuan for oil sales, that's significant. When European countries start discussing strategic autonomy from the dollar system, that's significant. When central banks around the world are diversifying their reserves away from dollars and into gold, that's significant. Each of these events individually might seem small, but collectively, they represent a trend, and that trend is away from dollar dominance. Now, what does this mean for you? What does this mean for someone who's trying to protect their wealth, grow their savings, and prepare for an uncertain financial future? It means you need to think seriously about having some exposure to physical precious metals, not as a speculation, not as a get-rich-quick scheme, but as insurance, as a hedge against monetary instability. Think about it this way. If the dollar maintains its strength, if the current monetary system continues without major disruption, if inflation stays under control and central banks manage a soft landing, in that scenario, your gold and silver holdings might not do much. They might just sit there holding their value. You won't lose sleep over them, but you won't get rich either. That's the downside case. But what's the upside case? What happens if we see a real currency crisis? What happens if inflation spirals out of control? What happens if there's a loss of confidence in fiat currencies? What happens if the paper precious metals market breaks and we see a massive repricing? In those scenarios, physical gold and silver could be the difference between preserving your wealth and watching it evaporate. And here's the crucial point. You can't wait until the crisis is obvious to everyone. By the time it's on the front page of every newspaper, by the time your neighbors are talking about it, by the time financial advisors are recommending precious metals, it's too late. The premiums will be astronomical. The availability will be scarce. The exit will have narrowed to the point where you can't get through. I've studied market history extensively, and there's a pattern that repeats over and over. The people who do well in major transitions are the ones who position themselves early. They're the ones who see the trend before it becomes obvious. They're the ones who are willing to look at data that contradicts the mainstream narrative and make decisions based on that data. Right now, the mainstream narrative is that everything is fine. The economy is resilient. The Fed has things under control. Inflation is coming down. The dollar is strong. And maybe that narrative is correct. Maybe we'll look back in 5 years and laugh at the people who were worried about currency crises and monetary instability. But what if it's not? What if the people who are quietly accumulating physical precious metals right now are seeing something that the mainstream is missing? What if the central banks that are buying gold by the ton know something that retail investors don't? I'm not saying you should panic. I'm not saying you should liquidate everything and buy gold and silver. That would be foolish. What I'm saying is that you should be paying attention. You should be looking at the data. You should be thinking critically about the monetary system and where it's headed. Let me give you another angle on this. The derivatives market for precious metals is enormous. We're talking about trillions of dollars in notional value. These are complex financial instruments that allow banks and institutions to bet on the price of gold and silver without actually owning the physical metal. And that's fine in a stable market. But what happens when that market becomes unstable? There's a concept in finance called counterparty risk. It means that when you hold a derivative or a paper claim, you're dependent on the other party fulfilling their obligation. If they can't or won't, your paper claim becomes worthless. Physical gold and silver have no counterparty risk. If you hold a gold coin in your hand, you own it. Period. No bank can fail and take it away from you. No government can print more of it. No counterparty can default on their obligation to you. In times of financial stress, that distinction becomes incredibly important. We saw it in 2008 when Lehman Brothers collapsed. We saw it during the European debt crisis. We saw it during every major financial crisis in history. The paper claims that looked solid suddenly became questionable. The institutions that seemed rock solid suddenly looked vulnerable. And the people who had physical assets, who had real things they could hold and control, were in a much better position. Now, I want to address something that skeptics often bring up. They say, gold and silver don't pay dividends. They don't generate cash flow. They just sit there. And that's true. But that's also missing the point. Gold and silver aren't investments in the traditional sense. They're not supposed to generate income. They're supposed to preserve purchasing power. They're supposed to maintain value when other assets are losing value. Think about what happened to the purchasing power of the dollar over the past century. A dollar in 1924 could buy what takes about $17 to buy today. That's a 94% loss of purchasing power. Meanwhile, gold has not only maintained its purchasing power, it's increased it. An ounce of gold in 1924 cost about $20. Today it's worth over $2,000. That's not just keeping up with inflation, that's dramatically outpacing it. And we're entering a period where that preservation of purchasing power is going to become increasingly important. Because the forces that drive inflation, money printing, government debt, geopolitical instability, they're not going away. If anything, they're intensifying. Look at the debt levels in developed countries. The United States has over $33 trillion in national debt. That number is growing by trillions every year. Japan's debt to GDP ratio is over 200%. Many European countries are carrying debt loads that would have been considered unsustainable a generation ago. How do governments deal with that much debt? Historically, there are only a few options. You can grow your way out of it, which requires sustained high economic growth. You can default on it, which is politically and economically catastrophic, or you can inflate it away, which means printing money and devaluing the currency. Guess which option governments typically choose? They inflate, they print, they devalue, because it's the politically easiest path. It's the path that doesn't require making hard choices or cutting spending or raising taxes dramatically. It's the path that kicks the can down the road and makes the debt burden smaller in real terms, even as the nominal number keeps growing. But here's the thing about inflation. It's a hidden tax. It's a transfer of wealth from savers to debtors, from the prudent to the reckless, from the people who hold cash to the people who hold hard assets. And if you understand that, if you really internalize what that means, then you understand why physical precious metals are so important. The currency exit I'm talking about isn't just about countries moving away from the dollar. It's about individuals moving away from fiat currency as a store of value. It's about recognizing that paper money, in all its forms, is a claim on value that can be diluted at will by central banks and governments. And it's about positioning yourself in assets that can't be diluted, that can't be printed, that have maintained value for thousands of years. Now, timing is always the question, right? When should you act? When is the right moment to increase your precious metals holdings? And the honest answer is that nobody knows for sure. Nobody can predict exactly when the next crisis will hit or when the next major repricing will occur. But what we can do is look at the conditions that typically precede major moves in precious metals. We can look at monetary policy and see that it's extraordinarily loose by historical standards. We can look at government debt and see that it's at levels that have historically led to currency crises. We can look at geopolitical tensions and see that they're as high as they've been in decades. We can look at the physical precious metals market and see that it's tight, with high premiums and limited availability. We can look at central bank behavior and see that they're accumulating gold at record rates. All of these factors point in the same direction. They point toward a repricing of precious metals. They point toward a narrowing of the exit. They point toward a moment when the people who positioned themselves early will be very glad they did, and the people who waited will be scrambling to get in at much higher prices. And here's something else to consider. The next major move in precious metals might not be gradual. It might not be a slow, steady climb that gives you plenty of time to react. It could be sudden. It could be a gap up in price that happens overnight. It could be a situation where the market opens one day and silver is up 15% and gold is up 10%, and by the time you try to buy, the premiums have doubled and the dealers are sold out. I'm not trying to scare you. I'm trying to give you a realistic picture of how these markets can move when conditions are right. And conditions right now are about as right as I've ever seen them. The fundamentals are there. The technical setup is there. The geopolitical backdrop is there. The monetary policy environment is there. All the pieces are in place. The question is, what are you going to do about it? Are you going to wait and see? Are you going to hope that the mainstream narrative is correct and that everything will be fine? Or are you going to take action now while the exit is still open, while physical metal is still available at reasonable premiums, while you can still position yourself before the crowd realizes what's happening? Because make no mistake, the crowd will realize it eventually. They always do. But by then, it's too late to get in at good prices. By then, you're buying at the top, paying massive premiums, and hoping you're not the last one through the door. I've been studying these markets for years, and I've seen this pattern play out multiple times. The people who do well are the ones who act when it's uncomfortable, when it feels early, when their friends and family think they're being paranoid. The people who do poorly are the ones who wait for confirmation, who wait for everyone else to validate their decision, who wait until it feels safe and comfortable. Right now, buying physical precious metals doesn't feel urgent to most people. The stock market is doing okay. The economy seems stable. Life goes on. But that's exactly when you should be paying attention. That's exactly when you should be positioning yourself. Because by the time it feels urgent, by the time everyone agrees that you should own gold and silver, the opportunity will have passed. The currency exit is narrowing. The window is closing. Not tomorrow, not next week, but gradually, inexorably, as more people wake up to what's happening in the monetary system, as more central banks diversify away from dollars, as more countries explore alternatives to the current system, as more investors demand physical delivery, as the disconnect between paper prices and physical reality becomes impossible to ignore. You have a choice to make. You can be early or you can be late. You can position yourself now or you can wait and hope. You can take control of your financial future or you can leave it to chance. The data is there. The trends are clear. The opportunity is in front of you. The only question is whether you'll act on it before the exit narrows to the point where you can't get through.